3 million cars. That's how many are on track to be repossessed this year. The car repossession crisis is exploding, and it's coming for you. Right now in the United States, auto loan delinquencies over 60 days past due are sitting at their highest levels in over a decade. Subprime defaults have already surpassed 2008 peaks. Prime borrowers, people with good credit, are falling behind at the fastest rate since tracking began. The average new car payment is now hovering around $740 a month. Used cars are pushing $580, and that's before insurance, which in many states has jumped 20 to 40% year over year. Total auto debt has crossed $1.6 trillion, the highest in history. And here's the part nobody wants to say out loud. Repossessions are accelerating even without a declared recession. Tow trucks are working overtime. Recovery databases are scanning millions of license plates daily. Lenders are shortening grace periods. And once you're 60 to 90 days behind, the process moves fast, often without warning. You might think this only applies to people who made reckless decisions. It doesn't. Defaults are rising among borrowers with credit scores above 660. Households earning six figures are missing payments. Insurance spikes, job instability, medical bills, and record negative equity are pushing people over the edge. And when that car disappears from your driveway, it's not just transportation you lose, it's credit access, job stability, and financial breathing room for years. This isn't a fringe issue. It's not isolated. It's systemic. And if you're financing a vehicle right now, especially on a long-term loan, you are closer to this than you think. What most people don't realize is that this repossession crisis didn't start with missed payments. It started years earlier when the structure of auto loans was quietly rewritten in a way that almost guarantees failure for the average borrower. If you rewind even 10 years, a standard car loan was 60 months, sometimes 72 if things were stretched. Today, 84-month loans are normalized, 96-month loans are increasingly common, and lenders are actively testing terms that go even longer. Not because cars last longer, but because incomes haven't kept up with prices. According to Experian's most recent auto finance data, the average new car loan term is now over 69 months, the longest ever recorded, while the average loan amount has crossed $41,000, also a record. That combination alone should tell you something is wrong. You're not financing transportation anymore, you're financing depreciation. And here's where it gets dangerous. The longer the loan, the slower the principal gets paid down, which means even a small disruption, a medical bill, a layoff, a rent increase, immediately pushes you into negative equity with no exit. You can't sell the car, you can't refinance without a loss, and you can't trade it in without rolling debt forward. That's how people end up trapped. This is why first payment defaults are exploding right now. Borrowers sign deals that technically work on paper but collapse the moment real life shows up. And lenders know this. They've modeled it. Internal risk disclosures from major auto lenders already assume higher default rates on long-term loans. They just offset the risk with higher interest and faster repossession timelines. So when you hear someone say, just extend the loan to lower the payment, understand what that really means. You're stretching a fragile financial situation across more time, not fixing it. The repossession doesn't come because you were irresponsible, it comes because the math was never survivable to begin with. Insurance, taxes, and fees are pushing borrowers over the edge. Even if you're one of the people still managing to make your car payment, there's a second pressure point that's quietly breaking households. The total cost of ownership is exploding faster than wages, and repossessions are increasingly triggered by everything except the loan itself. Insurance premiums have surged nationwide, with many drivers seeing 20 to 30% increases year over year, especially in urban areas and high-theft states. In some metros, full coverage insurance on newer vehicles now exceeds $300 to $400 a month, meaning your $650 car payment is actually a $1,000 transportation bill once insurance, fuel, registration, and maintenance are factored in. And that's before property taxes, tolls, parking fees, or surprise repair costs. What's happening now, and lenders are openly acknowledging this in earnings calls, is that borrowers are choosing which bills to pay each month. Rent comes first. Utilities come first. Food comes first. And when something has to give, the car note gets pushed back just for a month. That's all it takes. 60 days late is now enough to trigger aggressive recovery in many states, and lenders have shortened grace periods compared to pre-pandemic norms. Add to that the rise of usage-based insurance tracking, where driving behavior or mileage can cause premiums to spike mid-policy, and suddenly people are falling behind without even realizing how close they are to default. This is why repossessions are no longer concentrated only among subprime borrowers. Data from the New York Fed shows delinquencies rising fastest among borrowers with credit scores above 660, meaning people who, on paper, did everything right. The system is less forgiving now. Fees compound faster, recovery is automated, and once you're flagged, the process moves with very little human discretion. The scary part isn't that people can't afford cars, it's that they almost can, right up until they can't anymore. Repossession is becoming faster, quieter, and harder to fight. This is where things take a turn that most people aren't psychologically prepared for, because repossession no longer looks like it used to. There's no knock on the door, no warning call, no chance to explain. Modern repossession is increasingly silent, data-driven, and automated, and that's why so many people describe it as traumatic. License plate recognition systems now scan millions of vehicles per day, feeding real-time location data to recovery networks. Some lenders integrate GPS data directly from vehicle telematics, meaning the car itself is helping locate you. In several states, recovery agents are now dispatched algorithmically the moment an account crosses a delinquency threshold, not when a human decides it's time. That's how you get situations where people step outside for work and their car is just gone. No confrontation, no conversation, just absence. And legally, in most jurisdictions, lenders are allowed to do this as long as there's no breach of the peace. They don't need to notify you first. They don't need to explain afterward. And once the vehicle is recovered, fees stack immediately: towing, storage, administrative processing, often adding $1,500 to $3,000 to the balance overnight. Many borrowers never get the car back even if they catch up on payments because the reinstatement amount becomes impossible to pay all at once. This speed is intentional. Lenders learned from 2008 that delays reduce recovery values, so the new system prioritizes asset seizure over borrower resolution. And this is why stories like the van being taken from a man with no legs aren't anomalies, they're the logical endpoint of a system that no longer evaluates circumstances, only contracts. The process doesn't care why you fell behind. It only cares that you did. And that's why this crisis isn't slowing down, it's accelerating. Here's what most people still don't understand about this repossession surge. The real damage doesn't happen when the car is taken, it happens when the numbers are calculated afterward. Because when your vehicle is repossessed, the lender doesn't just erase the debt. They sell the car at auction, usually at a wholesale price far below retail, subtract the proceeds from your outstanding balance, and then send you a bill for the difference. That's called a deficiency balance. And right now, those balances are getting brutal. Used car values have cooled from their 2021 peak, wholesale auction prices have normalized, and in some segments, especially EVs and oversized trucks, depreciation is accelerating. According to Cox Automotive data, wholesale used vehicle prices have declined significantly from pandemic highs, which means when your $48,000 SUV gets repossessed, it might auction for $27,000, while you still owe $39,000. That gap doesn't disappear. You still owe it. And because so many loans were written with rolled over negative equity from prior trades, some borrowers are entering repossession already $5,000 to $10,000 underwater before the first tow truck ever shows up. That's the trap. You were upside down the day you signed, and now lenders are pursuing deficiency judgments more aggressively than they did pre-pandemic because recovery departments are under pressure to offset rising default rates. Wage garnishment, lawsuits, settlements, collection agencies buying debt for pennies and chasing you for years. So when someone says, "I'll just let them take it," they're only thinking about losing the vehicle. They're not thinking about the 5-year credit destruction, the inability to qualify for housing, the insurance spikes tied to credit scoring, or the fact that auto lenders now flag prior repossessions as high risk for up to 7 years. And here's the systemic angle. The more underwater loans exist in the system, the more fragile the entire used car market becomes. Because when repos accelerate, supply at auction rises. When auction supply rises, prices fall. When prices fall, more borrowers go underwater. That feedback loop is how localized financial strain turns into an industry-wide unwind. And we are closer to that loop than most people realize. This is no longer just a subprime problem. For years, the narrative was simple. Repossessions happen to people with bad credit, unstable income, and risky loans. But that narrative is outdated and dangerously misleading. What's unfolding now is a broadening of financial stress into middle credit and even prime credit borrowers, and that changes everything. Data from the Federal Reserve Bank of New York shows that serious delinquencies, 90-plus days past due, are rising fastest among borrowers with credit scores between 660 and 719, not just below 600. That means teachers, nurses, office managers, small business owners, people who traditionally would not be considered high risk. And when delinquencies move up the credit spectrum, the total dollar volume at risk multiplies quickly because these loans are larger. Prime borrowers finance bigger vehicles, longer terms, higher trims. So while subprime defaults may be more frequent, prime defaults carry heavier balances. This is why lenders are quietly tightening standards again, raising required down payments, scrutinizing income documentation more closely, and increasing rates even for good borrowers. And here's the part that should make you pause. Many of these prime borrowers took out loans during the 2020 to 2022 period when vehicle prices were inflated 20 to 40% above pre-pandemic norms. They locked in large balances at historically low rates, which felt safe at the time. But now, insurance is up, maintenance is up, property taxes are up, and wages haven't kept pace with cumulative inflation. So even without a recession officially declared, households are experiencing what feels like a rolling income compression. When liquidity tightens, discretionary spending disappears first, then savings get drained, and eventually installment debt gets prioritized based on survival, not pride. That's why repossessions are spreading geographically as well, not just in traditionally high default regions, but in suburban and upper middle income zip codes. And once prime borrowers begin defaulting in volume, the psychological impact shifts, because it's no longer those people. It's your neighbor. It's your coworker. It's someone who looked financially stable 6 months ago. And when that line blurs, the crisis stops being anecdotal and starts becoming structural. Job instability is the silent trigger nobody is pricing in. What makes this repossession wave different from previous cycles isn't just the size of the loans or the length of the terms, it's the timing relative to labor market fragility. On paper, unemployment numbers may not look catastrophic. Headlines still talk about resilience. But beneath that surface, there's a shift happening that lenders cannot fully model. Income volatility is rising. Contract work is up. Commission-heavy compensation is up. Overtime is disappearing in sectors that relied on it. White-collar layoffs, particularly in tech, finance, logistics, and media, have eliminated hundreds of thousands of higher-paying roles over the past 2 years. And when someone earning $110,000 drops to $70,000 or worse, drops to zero for 6 months, that 84-month auto loan becomes the first domino. Auto debt is uniquely sensitive to job shocks, because, unlike a mortgage, there is no long foreclosure runway. There is no year-long negotiation. There is no federal modification program quietly absorbing pressure. Miss 2 or 3 payments, and the system moves. That's it. And here's what most borrowers underestimate. Even if you regain employment, you often cannot catch up because lenders increasingly require full reinstatement amounts rather than partials. So, a temporary job loss becomes a permanent credit event. Now connect that to macro conditions. Household excess savings built during the pandemic have largely been depleted according to Federal Reserve tracking. Credit card balances are at record highs, now exceeding $1.1 trillion nationally. Delinquency rates on credit cards are also climbing, particularly among younger borrowers. What that tells you is that people are using revolving debt to bridge income gaps, and when those limits max out, Installment loans like auto debt start collapsing next. The car is often the largest non-housing liability in a household budget. Remove stable employment from the equation, and the math deteriorates fast. So when someone says, "I've never missed a payment in my life," that may be true until their company restructures, until their hours get cut, until their side income slows down. And in an environment where job security feels more conditional than it did 5 years ago, that risk is not theoretical. It's embedded. The auto loan market has been financialized beyond recognition. There's another layer to this crisis that doesn't get enough attention, and it's the part happening behind the scenes, the securitization machine. Auto loans today are not just contracts between you and a bank. They are bundled, sliced, rated, and sold as asset-backed securities to institutional investors. Pension funds, insurance companies, hedge funds. That means your car payment is feeding into a structured product designed to generate predictable yield. And when delinquency rates start rising, those structures start wobbling. Now, this doesn't automatically mean 2008 again, but it does mean incentives shift. Servicers are under pressure to demonstrate recovery discipline. Investors demand performance consistency. Rating agencies monitor delinquency buckets closely. So what happens when early-stage delinquencies climb? Servicers accelerate recoveries. They tighten loss mitigation. They repossess faster to preserve collateral value. In other words, the financial plumbing behind your loan can make the process colder, not more forgiving. According to S&P Global and other market trackers, subprime auto ABS delinquencies have already surpassed pre-pandemic levels, and prime pools are trending upward as well. When securities begin to show stress, capital markets react, which can cause lenders to raise rates, reduce approval volumes, or demand higher down payments. That contraction feeds back into consumers who are already stretched. Fewer refinance options, fewer rollover approvals, less flexibility. And remember, dealerships often originate loans not because they believe in the borrower's long-term stability, but because the loan can be sold upstream almost immediately. That separation of risk where the originator doesn't hold the long-term exposure historically creates looser underwriting during boom phases. We saw this dynamic in housing. Auto lending adopted a milder version of it over the last decade. So now, as defaults rise, the securitized market doesn't ask why someone fell behind. It asks how quickly losses can be contained. That's why this crisis feels impersonal. Because structurally, it is. Your missed payment isn't just a missed payment. It's a variable in a bond pool somewhere, and the system is engineered to correct that variable efficiently. The psychological shift is what turns a crisis permanent. This is the stage most people underestimate because it doesn't show up cleanly in charts or quarterly reports, but it's often the point of no return, the psychological break. When enough people stop believing they can catch up, behavior changes in a way that data always lags. Early in financial stress cycles, borrowers scramble. They sell things. They pick up extra shifts. They borrow from family. They move money around. But once the belief sets in that the gap is unbridgeable, that the loan will never make sense, that the car will never be worth what's owed, that the payments will never feel manageable, effort collapses. Economists sometimes call this strategic default, but that term makes it sound calculated and cold. In reality, it's resignation. People mentally write the car off months before it's repossessed. They stop maintaining it. They stop caring about the credit impact because the damage already feels done. This is how repossessions accelerate suddenly, even without a sharp economic trigger. And we're seeing the signs everywhere. Online searches for voluntary repo and how long before car gets repossessed have spiked. Social media is full of normalization language. It happens to everyone. Credit resets. I'll just start over. That shift matters because credit systems rely on social pressure as much as math. The idea that default is shameful or rare keeps people prioritizing payments beyond pure logic. When that social pressure erodes, models break. Lenders begin assuming higher default probabilities, not just because of income metrics, but because borrower behavior has changed. And once that assumption becomes widespread, underwriting tightens further, interest rates rise, and the system self-reinforces. The tragic part is that this mindset doesn't stay isolated to auto debt. It bleeds into credit cards, personal loans, even rent. When transportation is lost, job stability weakens. When job stability weakens, everything else follows. That's how a car repo becomes a life event, not a transaction. The spillover effects are just beginning to show. By the time we get to this point in the cycle, the question is no longer whether repossessions are rising. That's already confirmed. It's how far the damage spreads. And this is where things start affecting people who never took out an auto loan in the first place. Because rising repossessions don't stay contained in driveways, they ripple outward. Used car markets absorb the inventory first, pushing prices down, which worsens negative equity for remaining borrowers. Insurance companies adjust risk models based on credit deterioration, raising premiums even for drivers who have never missed a payment. Employers in car-dependent regions see higher absenteeism and turnover when workers lose transportation. Municipal budgets feel strain when vehicle registration and sales tax revenue declines. Even lenders themselves start tightening across product lines, making credit harder to access for everyone. We're already seeing early versions of this. Some regional banks have pulled back on auto exposure entirely. Credit unions are shortening max loan terms again. Buy here, pay here lots are seeing higher inventory turnover, but lower net recovery per unit. And here's the uncomfortable truth. Once repossessions reach a certain scale, policymakers rarely step in specifically to stop them. Auto debt doesn't have the political weight of housing. There's no widespread forbearance program waiting in the wings, no mass modification effort. So the adjustment happens the hard way through loss, through defaults, through credit destruction that takes years to unwind. And because cars are essential for employment in most of the U.S., the fallout compounds faster than people expect. This is why economists watch auto delinquencies closely. They're often an early indicator of broader consumer stress, not because cars are special, but because they sit at the intersection of credit, employment, and daily survival. When that intersection starts breaking down at scale, it's rarely isolated. It's usually the warning flare. The system is quietly training people to fail. What makes this moment genuinely disturbing isn't just the number of vehicles being repossessed or the speed at which it's happening. It's the realization that the entire system has evolved in a way that almost requires failure from a growing share of the population in order to function. Think about what's being normalized right now. Cars priced at $45,000 are marketed as entry-level. Loan terms stretch so long they outlive the mechanical lifespan of the vehicle. Payments are engineered to look affordable only because risk is deferred, not removed. And all of this is happening in an economy where income stability is weaker, insurance costs are volatile, healthcare expenses are unpredictable, and savings buffers have been drained. In other words, the margin for error has disappeared, yet participation is mandatory. You need a car to work. You need work to pay the loan. And the loan is structured so that even mild disruption pushes you underwater. That's not an accident. Auto lending has become less about enabling mobility and more about extracting yield from duration. The longer you stay in the loan, the more profitable you are. The moment you fall behind, you're still profitable through fees, recovery, resale, and deficiency balances. Even repossession itself has become monetized, with entire ecosystems built around tracking, towing, storage, auctioning, and collection. The borrower's outcome is almost irrelevant to the machine once the contract is signed. And that's why stories that once felt unthinkable, vans taken from disabled people, cars pulled while families sleep, recoveries executed with zero warning, are no longer shocking to the institutions involved. They are simply process. What should scare you is not that people made bad choices. It's that many people made reasonable choices based on the options presented to them, and those options were never designed for long-term success. When millions of people are placed into financial structures that assume uninterrupted income, perfect health, stable expenses, and constant economic growth, default stops being a personal failure and starts becoming an expected outcome. That's what this crisis really is. Not recklessness, not irresponsibility, but a system that quietly shifted risk downward, normalized fragility, and then automated the consequences. And once you see that clearly, it becomes impossible to unsee because the car repossession crisis isn't just coming for someone else. It's the byproduct of a model that only works as long as someone is always falling behind. If you take nothing else away from this, understand this. Car repossessions don't happen because people suddenly become irresponsible. They happen because the system quietly removes your margin for error. Longer loans, higher prices, rising insurance, volatile income. One disruption is all it takes, and once the process starts, it doesn't slow down for explanations, good intentions, or hard luck stories. It moves on contracts and algorithms. If you're watching this and you still have your vehicle, this is the moment to be honest with yourself. Not fearful honest. Know where you stand. Know how much equity you actually have. Know how many months you could survive if something went wrong. Because the people getting hit right now thought they had more time too. This crisis isn't finished. We're still working our way down to the core of it. And what comes next doesn't just affect borrowers, it affects the entire credit system around you. So let me know in the comments. Have you noticed repos increasing where you live? Have payments, insurance, or rates pushed you closer to the edge than you expected? I read every comment, and your experiences matter more than headlines. If you want to understand what's really happening before it shows up in your driveway, make sure you're subscribed. More parts are coming.